So we talked through all the journal entries. The last piece is the closing process. And so the closing process is just closing sales to income summary. And we walked through how that flows in earlier class, the last lecture. And so what's different about the merchandising business is that we also have to close out sales discounts, sales returns and allowances, and cost of goods sold to the income summary account as well. That's the only difference in the process. And so remember, these two are contra revenue accounts, and the cost of goods sold is a cost account. So since they have debit normal balances, they're going to ultimately decrease net income. And so they're going to be a debit balance to the income summary account. And then just remember that income summary ultimately gets closed to retained earnings, and that retained earnings will be reduced by dividends. So here's another example of how we'd go through all the debits and credits. I think this is worthwhile to run through quickly ourselves, right? Let's see, a merchandising inventory includes physical count. Let's see, prepare the entry to record inventory shrinkage and prepare the 4 closing entries. And so on May 31st, we have a cost of goods sold of 100 and merchandise inventory decrease of 100. And that's going to be because our merchandise inventory decreased by $100 for expected shrinkage. That's 656. Is our inventory still available? Let's see, is that the same amount we had up here? But we had 756 on our books. So that's how shrinkage is going to be recorded, right? We had 756 on our books, which we see up here. But then in the fact set, it tells us when we did our count, we only had 656 on our shelves. And so we'd have to reduce our inventory and increase our cost of goods sold for the shrinkage of 100. So that's how you'd go about doing a shrinkage calculation. Then the next piece is how would we do the closing entries? We just close the total sales to our income summary. The total sales are, let's see, I think it says it up here, the 4,300, so that's a given, to our income summary. And then we'd reduce our income summary or have a debit balance of income summary for all the discounts, the allowances, the cost of goods sold, and all the other expenses. And then we'd also decrease it for the remaining balance would get plugged to our retained earnings. So that I'm not going to go into too much detail for the closing process because we've gone over it before. Just make sure you understand how that all gets closed to income summary. Ultimately, we'll go to the balance sheet income statement. And I'd review those journal entry practices that I gave. I think that would be pretty helpful. So see, define and prepare multi-step and single-step income statements. The multi-step income statement versus a single-step income statement. This is really important because most of the financial statements you're going to see and assess are going to be multi-step, but the single step is just a different way to present the information. Same information, different presentation. And so this income statement, it's a multi-step if we have the calculation of the gross profit. Then we also have income from operations and income from non-operating activities. So you're generally going to see this on most large companies. So what's our gross profit? That's going to be our removing for our cost of goods sold. So you can see here, and I want us to understand this, so rewatch this, listen to this. This is important. We have our sales. That's our gross amount. Learn this terminology. Sales means our gross sales, our total amount of sales. Less our sales discounts and our sales returns and allowances is our net sales. So right, our gross sales minus discounts and returns and allowances is our net sales. Learn this terminology. Gross sales versus net sales. The net sales are normally what's presented on a company's financial statement. The gross sales are just for our own information. The net sales minus the cost of goods sold is our gross profit, right? So we have gross sales, our net sales, and our gross profit. We just whittle down the number. So gross sales and net sales can be very different. The net sales minus our cost of goods sold equals our gross profit. Our gross profit minus our operating expenses is our income from operation. What are example of operating expenses? That's going to be our sales salary expense, our depreciation expense, our rent expense, store supplies expense, advertising expense, anything that we need to do to continue operating our business, but isn't directly attributable to what we're selling. This can be broken out as G&A expenses, general and administrative expenses, and then we might have research and development expenses, and so on and so forth. Then we have our income that is non-operating. So maybe we make interest revenue, maybe we make trades, maybe we make sales that aren't something we do in our day-to-day operations. That would be our income, non-operating income. Then our net income is the gross profit plus or minus our income from operations and our non-operating income. So this is a multi-step. This is generally what you'd see for a large company. So make sure you understand, if I ask you how to do an operating, a multi-step financial statement, you'd need to tell me gross sales, net sales, gross profit, operating income, non-operating income, and net income. Those are the 6 things you need to be able to calculate. How's that different from a single step? Single step is just our revenues minus our expenses equals net income. Net income is the same. This is the same information. It's just presented at a higher level of detail in the multi-step. Does that make sense? Now for the balance sheet, I'm going to add a level of information for you. So balance sheet is presented in liquidity. And so we have, what is liquidity? Liquidity means how quickly can we convert an asset to cash? Because cash is king. At the end of the day, if you could have anything, if you could have $1 million, would you rather me give you $1 million? Would you rather me give you $1 million house? The answer is you'd want $1 million because you'd have to sell the house. It might not be what you want. With $1 million, you could buy whatever the heck you want. So here, we're always going to go by liquidity. Cash is always first. Our current assets, the assets we can convert to cash in less than a year, then our accounts receivable, then our merchandise inventory, then supplies, then our prepaid assets. This makes sense, right? A cash is the most liquid because it's cash. Accounts receivable, expected to be cash generally in 30 to 60 days. Merchandise inventory, we expect to sell, hopefully within 60 to 90 days. Supplies, we could sell, but we don't intend to. And then prepaid insurance, the same thing. We could ask for our money back, we could cancel it, but we don't intend to. So this is in liquidity. How quickly can we convert everything into cash? So the question here, just so you know when you practice it on your own, it's asking prepare a multi-step income statement for all the separate categories, and then prepare a single step income statement as well. And so here you can go through and do that, but we just take our total sales, make sure that we have our net sales afterwards by reducing all our discounts. We reduce that by our cost of goods sold, which is here, to get our gross profit. And then we reduce all of our direct operating expenses to get our total, operating income. Here, we don't have a difference between operating income and non-operating income. They didn't differentiate that, so it's just going to be your net income. But generally, you'd have both. The single step is much simpler. We just have the net sales minus all our expenses equals our net income. We exclude the gross profit. We exclude the gross sales. We exclude the operating and non-operating pieces. Why would you want a difference? What would you want as an investor? It's nice to have both, right? As a manager, I'd probably rather have this. If I'm a high-level manager, to say, hey, how much money did the business make? But if I'm in the details manager, or if not a VP, but if I'm a direct manager, or if I'm really interested in cutting pennies to see if there's a company that's profitable, I might see, hey, where are they wasting their money on and operating from an operating expense perspective? How good is their margin? How is their margin compared to competitors? So each level of information has a different value associated with it. But the more detailed, you can always get this information from the more detailed, right? It's easier to do that. From this, we don't know enough detail. Like we don't have enough background about the business to make some of the judgment calls on how they're spending their expenses. So on a company's financial statements, you might see a single step here on their financial statement or income statement. And then in the notes of the financial statement, they'll break out all of this detail. So